What's up everybody? It's Rehara back with another video. And today we're diving deep into one of the most influential investment books of all time. The Intelligent Investor by Benjamin Graham. Now, if you're serious about building wealth in the stock market, this is the book that should be on your shelf, dog-eared and highlighted, because the wisdom in this thing is timeless. Make sure you hit that subscribe button and turn on notifications so you don't miss out on future book breakdowns. Alright, let's break down the first key concept from The Intelligent Investor, the crucial difference between investing and speculating. See, Graham hammers this home right off the bat. Investing is about owning a piece of a business, understanding its value, and patiently holding on to it for the long haul. Speculation, on the other hand, is more like gambling. It's trying to predict short-term market swings, chasing hot tips, and hoping to get rich quick. And let me tell you, that's a recipe for disaster. Graham teaches us that intelligent investors focus on the fundamentals. We're talking about digging into a company's financial statements, analyzing its earnings, its assets, its management team, and understanding its competitive advantage. We want to know what that business is actually worth, regardless of the stock price's daily gyrations. Now, let's talk about one of Graham's most powerful concepts, the margin of safety. This is all about buying assets for significantly less than their intrinsic value. Think of it like this. You want to buy a used car, right? You wouldn't just pay the sticker price without checking its condition, its history, and comparing it to similar cars. You'd want to make sure you're getting a good deal, right? Same thing with stocks. Never invest in a company unless you're confident it's trading for substantially less than it's actually worth. This margin of safety protects you from unforeseen events, market downturns, and even your own mistakes. Now, this is where things get interesting. Graham introduces us to this character called Mr. Market. Imagine Mr. Market as this emotional dude who shows up at your door every day trying to sell you stocks or buy yours. The catch is, Mr. Market is moody. Some days he's euphoric, willing to pay ridiculous prices. Other days he's downright depressed, practically giving stocks away. Here's the thing, you don't have to listen to Mr. Market. Remember, he's emotional, and we, as intelligent investors, are not. We use his mood swings to our advantage. When he's fearful, we buy when prices are low. When he's greedy, we sell when prices are high. Graham knows that not all investors are the same. That's why he outlines two main approaches, defensive and enterprising. Defensive investors, as the name suggests, are all about minimizing risk. They're like the steady eddy of the investing world. They diversify their portfolio broadly, often with low-cost index funds and bonds, and they don't try to time the market. They're in it for the long haul. Enterprising investors, on the other hand, are more hands-on. They're actively searching for undervalued stocks, doing their due diligence, and willing to put in the time and research. They're comfortable with a bit more risk, hoping for higher returns. The key takeaway here is to identify your own investing style. Are you a defensive investor who prefers a hands-off approach? Or are you an enterprising investor who enjoys the thrill of the hunt for undervalued assets? There's no right or wrong answer. It's about finding what aligns with your risk tolerance, your time commitment, and your financial goals. Now, let's talk about the nitty-gritty of evaluating businesses, because that's what separates the intelligent investor from the gambler. Graham stresses the importance of fundamental analysis. This means digging deep into a company's financial statements, understanding its revenue streams, its expenses, its debt levels, and its profitability. We want to see consistent earnings growth, strong cash flow, and a healthy balance sheet. But it's not just about the numbers. We also need to analyze a company's competitive landscape. What's its market share? Who are its competitors? Does it have a durable competitive advantage? We need to understand the business model inside and out. Remember, we're not just buying pieces of paper, we're buying ownership in real businesses. So, there you have it, guys. Those are some of the core principles from The Intelligent Investor. Remember, investing is a marathon, not a sprint. It's about patience, discipline, and making rational decisions based on sound principles. Now, if you found this breakdown helpful, hit that like button and let me know what you thought in the comments below. And hey, If you're looking for more book summaries like this, drop your suggestions in the comments. I'm always down to explore new wisdom and share it with you guys. Don't forget to subscribe and hit that notification bell so you don't miss out on future videos. Until next time, stay invested, stay informed, and keep crushing it.